Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stocks are gaining for a second day as calm returns to markets following President Trump's U-turn on Greenland. We'll dig into why investors are now turning their attention back to AI as perhaps the next market catalyst. Plus, fresh economic data this morning showing the U.S. economy is holding steady. We'll preview what to expect from the Fed's preferred inflation gauge. That drops at 10 a.m. Eastern today. And crypto firm Blikre is going public. It's the first big IPO of the year. The digital asset custodian raising $212 million for its initial public offering. We'll speak to Blikre CEO Mike Belshi as we await the stock's first trade. Let's take a check on stock futures. We had a relief rally yesterday after President Trump spoke in Davos, and that relief rally is continuing today. Right now, we got futures indicating a higher open. The NASDAQ leading those gains, indicating a jump of about 1% at the open. Let's talk more about all of this because President Trump's U-turn on Greenland and a renewed focus on the AI trade, they seem to be driving stocks for a second day of gains after a turbulent start to the week, to say the least. For more on the catalyst driving the market, we're joined by Yahoo Finance markets and data editor Jared Blikre and by Treasury Partners Chief Investment Officer Richard Saperstein, who oversees $16 billion in assets under management. Jared, I'm going to start with you. Give us a tour of what happened and what is happening this morning.
Well, let's take a look at what's happened overnight. And this is very indicative. You can see the Wi-Fi Interactive behind me. Everything is in the green, and especially in the U.S., where we have Dow futures, S&P, NASDAQ, Russell 2000 futures, all up. And the NASDAQ 100 futures are what is outperforming. That's up 1%. And you can see that's a nice rally there. If I put a 5-day view, you can see the turbulence we've had. We got that big drop earlier in the week, followed by the big rise. And we'll dig inside to some of the components in a minute here. But I just want to point out what the VIX has done this year. And VIX, some people call it the fear gauge. Steve Sosnick over at Interactive Brokers would call it a gauge of institutional hedging demand. Whatever you want to call it, we had a little bit of fear in the market a few days ago, and we are back down to pre-fear levels. So that is a good thing. A lot of that fear has dissipated in the market. Sell America has turned into buy America. And it's really been a story of the small caps. This is a Russell 2000 year to date, 8.71%. We hit a record high yesterday. The S&P 500 and the other majors have not yet recovered those losses from earlier in the week, but the micro caps, the small caps, and the mid caps, you can take a look at the S&P 400 right here. That's mid caps doing the same thing, which is outperforming. And that is something we haven't seen in a while. The Russell 2000 finally maybe achieving liftoff off of those old highs after many fits and starts over the last few years. And then we got to check in on the bond market as well. Here's a 30-year, what it's done this year. 30-year T-bond yield down, we're going to call that break even, 4.87%. We got a little close on an intraday basis to 5%. That was one of those big psychological levels that a stock market just doesn't like. And we did see stocks roll over, as it has happened in that case many times before over the last few years. So bonds are not screaming any disaster here. Dollar's not screaming any disaster. So it looks like things are on the upswing here, Julie.
Yeah, and I would just offer one precision on something you said. You said it's buy America now. I mean, it's not just buy America. It's kind of buy everything, right? Because the European stocks are rising also. So it's not sort of a trade-off of one for the other. Richard, I want to bring you into this discussion because obviously, as we've been talking about, there's been a lot of focus on geopolitics this week. We've seen the swings in the market. How do you handle that as somebody who is managing money?
Well, within the framework of a three-tiered analysis of fundamentals, Fed, and geopolitics, the geopolitics is the wild card this year. Obviously, POTUS is going to have a lot of self-inflicted wounds on the market, yet we have to look back to last April when we had Liberation Day. And as I said, it's self-inflicted, so they'll naturally cure themselves. So what we're doing... So
is this taco by another name? Is what you're talking about? Trump always chickens out, that the market reacts and then he backs off?
I think I think as an investor, we have to look at the other two fundamentals I mentioned, which is the economic landscape, which is very positive, the Fed, which will be very accommodative. And then when we look at this last one, creating the volatility, it's creating buying opportunities as a result of the other two being very positive.
Gotcha. So in other words, you think the fundamental backdrop is positive, and you're not worried that this volatility will spill over into fundamental. It's just going to sort of be surface market volatility?
No, it's very separated and segregated. When we look at the fundamentals, which is declining inflation, a robust economy, we've got excellent jobs. Jobs are moderating but growing. But we've got an excellent backdrop for earnings growth. And we've had 12 quarters of successive earnings growth. I think we continue with that. And as you know, stock prices follow earnings.
Right.
So from that perspective, the landscape is very positive. When we look at the Fed, it's going to be accommodative. Obviously, we're going to have a new Fed chair. So when we combine the fundamentals of the economy, the Fed, and the geopolitical scene, which will be filled with these self-inflicted wounds, they present an opportunity because the backdrop of investing today is very good.
And so where are you looking right now? And has where you're looking changed in 2026 from 2025?
The playbook is about maintaining and then considering some broadening out of the market. So maintaining is our core positions in large cap technology, the AI universe. That trend is really one of the main ones driving the economy. For example, high net worth spending and the AI tailwinds is actually driving economic activity now. So we want to stay with that. We want to avoid the selective capitalism being handed out by POTUS. For example, whether it's credit card companies or institutional home owners.
Right, but how do you know where that's going to land next is the problem. So you avoid it when it happens, but that's by sort of definition being reactive then instead of proactive.
Yeah, I'm not sure I'd be buying those names after they go down.
Right.
But I try to avoid what is a known.
Mm-hmm.
Obviously, we don't know what's coming up next. Areas of opportunity on the broadening out theme will be in consumer goods, banks, other areas where they rotate away from the AI and technology trade.
Interesting. So you want to own the AI and technology trade, but at the same time, you want to get into some of those broadening areas. Do they have to be integrating AI, or it's separate entirely from that theme?
Well, I think that's the theme that's going to occur over the next few years, where many industry groups will continue to integrate, embrace, and become more efficient by adopting AI. And the primary outcome will be higher margins, and we'll also see greater efficiencies in their operations. Mm-hmm. So that margin improvement will lead to greater operating cash flow and hence free cash flow. So AI adoption is going to be a long-term process for corporate America, which will ultimately benefit earnings.
Richard, thanks so much for coming in. Appreciate it.
My pleasure.
And now it is time for some of today's trending tickers. We're going to watch GE Aerospace, Abbott Labs, and Mobileye. First up, GE Aerospace. The stock erasing earlier gains ahead of the opening bell, despite reporting better than expected results for the fourth quarter. Both earnings and revenue topped Wall Street expectations, and the midpoint of the company's guidance also coming in above estimates. One concern that could be weighing on the shares, the rate of growth expected for 2026 is slower than last year. And Abbott Labs, shares of the medical device company, sinking on weak fourth quarter sales and disappointing first quarter guidance. The key factor there, weak sales in Abbott's nutrition division, which includes baby formula and protein drinks for adults. The company is saying disappointing sales were a result of new pricing actions to drive demand. And finally, Mobileye. That company reporting mixed results for the fourth quarter, but it's the guidance that is weighing on that stock ahead of the open. Its annual sales forecast missing the street's estimates as tariffs weigh on its key customers, automakers. Mobileye makes chips for assisted driving, and the pace of adoption has been slower than expected as well. The stock had recently gotten a lift during CES from some new announcements, but now we're seeing that leg lower. Coming up next on Morning Brief, we'll count you down to the opening bell and also dig into the economic outlook with Mark Zandi, Moody's Analytics chief economist. He'll join me next with the 3 factors he says will determine U.S. growth this year. The Trump administration projects that the U.S. economy will deliver 4 to 5% GDP growth in 2026. My next guest says the economy's growth projection is fragile. Joining me now, Mark Zandi, Moody's Analytics Chief Economist, to talk through this a little bit. Mark, I really appreciate you being here. And you sort of pinpoint three elements that economic growth this year will sort of pivot on, depending on how they stand. And the first of these really speaks to recent news flow. You talk about how aggressively the Trump administration pursues its tariff, immigration, and other deglobalization policies. Of course, that's been on center stage over the past few days in Davos. So what does that tell us about how that first one is going to work out and whether it is going to be supportive or not for growth?
Well, it's a headwind to growth. It's just a question of how strong that headwind is going to blow. I think it shaved almost a percentage point off of growth in calendar year 2025, and it's on track to do just about the same in 2026. I mean, a big wild card here, obviously, is the Supreme Court decision on the reciprocal tariffs. If they rule that those are unconstitutionally imposed, and the president has to eliminate them, that would reduce the headwind, assuming the president doesn't respond with other tariffs. But a lot of moving parts here. But at the end of the day, deglobalization, tariffs, immigration policy, export restrictions, investment controls, sanctions, visa limitations, all these things add up to a pretty significant headwind, and that will continue to blow hard, I think, in 26.
Well, and it's interesting, you also write in your piece, there's no quicker or more effective way to address the affordability concerns of voters than to lower tariffs. Obviously, that's not something that the president is super keen on doing. He's talked about doing other things to try to target affordability, some of the housing measures he's suggested, for example. Do those help at the margin, or does it really turn on tariffs?
Well, if you want to do anything this year on affordability, I think it'd have to be tariffs. Tariffs, the increase in tariffs in 25 added over half a percentage point to consumer price inflation. So if you want to get that inflation back down to something we can all feel comfortable with, closer to the Federal Reserve's 2% target, you'd have to get rid of those tariffs. But you're right, it doesn't feel like that's the direction the administration is headed. The other proposals, they're on the margin. I don't think they make a difference. Even if they, were implemented, they're not going to have an impact on affordability for quite some time. Certainly not this year in 2026. They play out over a long period of time. And all of them are on the margin. I mean, I know the housing ones pretty well because I spent a lot of time looking at the housing market. Right. They're all demand side measures, pretty much, trying to juice up demand. But when when the problem is you don't have enough supply, we don't have enough homes, the increase in demand will only make house prices go up more and just be very counterproductive in terms of affordability for first-time home buyers. So, I think if you wanted to address the housing affordability issues, you'd be focused on the supply side of the market, trying to incent more construction, more home building, rather than juicing up demand.
And Mark, I'm curious also about your focus on tariffs, given that economic growth has been largely okay, even given the tariffs. And there has been earnings growth as well has seemed to proceed pretty handily. So how are you thinking about the tariffs? I know you talked about what it's shaving off of economic growth, but if you look at the numbers in aggregate, I guess by and large they haven't been that bad. Yeah,
and that goes to you started the conversation with the three things driving growth. The headwind is deglobalization. One of the tailwinds is obviously artificial intelligence, AI, all the investment spending that's going on there. And of course, the surge in AI stock prices, which is running on its own dynamic, independent of what's going on in the rest of the economy. That's driving a lot of increase in wealth, which is driving a lot of consumer spending by the well-to-do. So that's a tailwind to growth. And that was a significant tailwind in 2025. And by the way, Julie, I wasn't surprised by the headwind from deglobalization, but I was surprised to the degree to which we got the tailwind from AI, and that's going to continue to blow as well as in 2026. But let me make one other point. When you're looking at GDP, okay, it's okay, but if you really want to see the impact of deglobalization and tariffs, just take a look at the job market. I mean, just take a look at this graph, a picture of payroll employment look at it over the past couple of years, you could see it steadily rising right up until Liberation Day, which was early April of last year. And since then, the economy has created no jobs, no net new jobs. It's completely flatlined. So that gives you a sense of the damage that the tariffs are doing. And for most Americans, by the way, Julie, it's not about GDP, it's not about earnings. What they care about is jobs. That's what
Right.
they're focused on. They understand jobs. And that's why most Americans are pretty uncomfortable with the way things are going.
Well, and the AI elements is something that cuts both ways. I mean, I know it was a tailwind last year, could be a potential tailwind this year. I guess the question we're all asking is, what's the boost to productivity on the plus side versus how quickly it tips over into job loss or no hiring on the negative side?
Yeah, good point. So demand and supply. I mean, most of the juice from AI last year was demand driven. There was a bit of a pickup in productivity due to AI, but pretty much on the margin. This year, that could be different. We could see more productivity growth. I mean, history would say, if you look at the history of technologies like the internet as the most recent case study, that the benefits of the productivity gains, the earnings growth you talked about, the increase in stock values, that benefit diffuses throughout the economy, creates other jobs, and you see job losses over here because of the technology, but you see job gains over there because of the increase in wealth and incomes. And the net of that is the job market's just fine. I think that's probably what's going to happen in 2026 is going to play to a draw in terms of what it means for the job market. But that is a risk. I mean, if AI comes on more quickly and businesses adopt and implement it more rapidly and the productivity gains are more substantive, and the economy doesn't have time to adjust to that, that could be a problem, right? Because the economy is already not creating any jobs. If that the AI boost to productivity is so significant that it causes job loss, that could be a problem for 2026.
And then the third item that you're watching closely is stimulus, both monetary and fiscal. And I believe you actually think there are going to be more rate cuts this year than the market is pricing in. Is that because you are more pessimistic, perhaps, about the job market?
Yeah, that's exactly right. I mean, I think the Fed, obviously it's got a tough job here, right? Because of tariffs, immigration policy that slows growth, and it also raises inflation. So how does the Fed respond? But I think in my calculation, the headwinds are going to blow hard enough, the job market's going to be weak enough that, and inflation less of an issue, that they will cut more in 2026. There's a lot of, is it 1/4 point cut? Is it 2? Is it 3? That's a reasonable debate. I expect 3. That's what I have in my expectations in my forecast. But I don't think I'd argue with anyone too strongly if they said 2 or 1 or 4. Something in that ballpark.
Mark, I want to turn to the research that you at Moody's did on the so-called K-shaped economy. And your latest analysis, 59% of all consumer spending comes from the top 20% of income earners. Listen, you've been doing this for a long time. I've been doing this for a long time. Something about right now feels different in that way in the United States. And I'm just wondering sort of how you're thinking about it more broadly, because normally this happens, the market's doing okay, the GDP's okay, even if folks at the bottom are not doing great. Is that different this time, or does it feel different than in past eras to you?
Yeah, isn't that an amazing statistic, though, Julie?
Yes.
I mean, the top 20% of the income distribution counts for 60% of the spending. That's just, and it gets even more crazy when you go further up the distribution. The top 10%, the top 1%, the top 1/10 of 1%. I mean, very concentrated, and it's become increasingly so. And I don't know that's a cliff event for the economy. I don't think that, but it's definitely a corrosive, and it's certainly a vulnerability, right? I mean, if our economy is so dependent on the well-to-do, and the well-to-do are obviously so dependent on the stock market, and the stock market is obviously very dependent on those AI stocks. I don't know. That doesn't feel like a really great place. That goes to my point about fragility. That feels fragile to me. That doesn't feel anything other than that. That's a potential threat. The other thing is, this makes it feel a little different. I do worry about AI in this context. I mean, it does, past technologies, remember we talked about how the benefits of that diffused out throughout the economy, benefited everybody pretty quickly. This feels like it might not be. It feels more concentrated. The companies that are dominating, they're hyperscalers, they're huge, they're massive, they need scale economies, and their shareholders are benefiting enormously. Are we going to see the benefits of this diffuse more broadly? And if we don't, then the income and wealth distribution, the spending distribution is going to become more skewed. And I think that has all kinds of things we need to worry about longer run. What does it mean for our politics, our fractured politics? Can we come to a consensus on anything if we got all these different, very widely different perspectives and performances across the income and wealth distribution? What does it mean for society, our societal ills, everything from drug abuse to homelessness and everything else? So I do worry about this, and I do think it's an issue. I don't think it's a near-term threat, but I think it's a longer-term problem that we're going to have to grapple with.
Yes, most definitely. And I look forward to talking to you about it more in the future when you guys come out with updated research on that front. Mark, thank you so much. Really appreciate it.
Yeah, anytime.
Thanks. Coming up on Yahoo Finance, opening bid with our executive editor, Brian Zandi, joining us now. Saz, what's coming up?
Hey, Julie. Eyes on some of these momentum stocks like AMD and NVIDIA. The dip buyers are back and forth. Also caught up with P&G CFO Andre Schulten, talk about their better than expected results. But still, I came away a little concerned, Julie, on the state of the U.S. consumer after that conversation. People seem to be dosing how much Tide they use in their laundry.
Yes, they're counting their pennies. Well, they're counting their nickels now, I guess, and there's no more pennies. Thanks a lot, Saz. Looking forward to it. That does it for Morning Brief. Much more ahead with Brian Zandi on Opening Bid.